We will not be introducing new vehicle models this year. It would not make any sense because we will still be parts constrained.
And some of these related companies to Tesla's fortunes and how some of them are trading right now. But certainly, I guess it's really more a macro story than really what happens with Tesla. But then again, of course, this still affects, of course, their fortunes moving forward. In fact, let's get it over now to Ed Ludlow and cross it over there to our West Coast reporter to really talk us through, of course, where we are here on this Tesla story. Ed.
Yeah, look, the supply chain story of Tesla touches so many different elements. You heard him speak there about the new products. Going into this, almost every investor I spoke to, be it a retail or institutional, a Tesla fan, my Twitter poll online, they wanted to know about Cybertruck. But Cybertruck's not happening this year. It's a next year product. Semi-truck is one that has been pushed and delayed a number of times. And again, it's pushed back to 2023 because Elon Musk's logic, as you heard on that soundbite, is we're struggling to get parts that we need for our existing models that we're trying to ramp up and build now, so it doesn't really make sense to launch products. At the same time, the two factories in Shanghai, for example, in Asia, in China, they have been operating at below capacity for a number of quarters now because of those supply chain pressures. In a year where they're launching two new factories, that's a little worrying for volumes and a little worrying for the bottom line.
Yeah, and talking about the bottom line, Intel with that weak profit forecast, I guess it's bringing doubt to a lot of the CEO's spending spree.
Yeah. There's two parts to this. You know, going into this earnings period, Wall Street was looking for strong forecasts, right? Strong outlook. And you saw a number of companies beat on the top and bottom line, but then give the tepid outlook. And for Intel, this is a company where margins are around 55%. Historically, they're between 60 and 65%. Now, when margins have dropped historically, that's because Intel's had to cut prices because of competition. But margins are lower right now because this is a company in investment mode. They're willing to spend. They're ramping up their fab output, they're building new factories, and that does have investors thinking, what is the profit outlook here? At a time where key cloud customers are pulling back on their chip spending as well.
And it's not a simple issue, really, to solve, is it? What does it mean for the Asia Pacific and some of the related companies, including, of course, suppliers and also partners and even peers of the likes of Intel, Ed?
Yeah, it's interesting because this goes back to the discussion that there's a difference in understanding between the White House and the industry, it seems, right? That building semiconductor factories takes a very long time. You can announce a splashy CapEx announcement, we will invest this. You see what the Korean chip makers, the Chinese chip makers are doing. They've all announced investment commitments. But these are ultra high-tech facilities, and they take a very long time to materialize, which means that in the near term, this quarter, the following 3 quarters, we're not going to see this kind of expanded capacity hit the top or bottom line. And that cloudy outlook is kind of what seems to have spooked investors.